So you bought a long-term rental, expecting cash flow, tax write-offs, but your CPA tells you those losses are just carry forward. What gives? Well, in today's episode, I'm giving you the breakdown on why some of your real estate losses get locked up when the IRS phases out your deductions, and most importantly, how to still win if you're over that $150,000 AGI threshold. This is about turning the frustration into strategy and actually planning for where you fit. Hi, my name is Anthony Brister, and this is a wealth planning podcast with Brister Law. And today I'm giving you the playbook for why losses from long-term rentals often get suspended, the exact IRS income thresholds that lock you out, and how to still come out ahead if your income is high. I'm also going to share some real-world examples of clients who got creative and won, and what the tax code doesn't tell you about planning around those rules. And also, I'm going to tell you how high earners are quietly compounding wealth without taking a single dollar of rental losses today. So let me tell you about Megan. She was a Houston tech exec, making around $165,000. She buys a beautiful fourplex, cash flow positive, and between rehab, bonus depreciation, and regular write-offs, she ends up with a $30,000 paper loss. She's excited until her CPA says, well, because of your AGIs over $150,000, you don't get to deduct those things this year. It's suspended. And Megan's frustrated. She bought that property expecting immediate tax savings, but here's the truth. She's still in a great position because the benefits of long-term rentals go far beyond the current year write-offs. So let's break down the rules first, and let's make the IRS code simple. So rental real estate generally is going to be passive by default. If you don't materially participate, you don't qualify as a real estate professional or use one of the loopholes, then you're limited by the passive activity loss rules. The $25,000 exception is if your modified AGI is below 100K, you can deduct up to $25,000 in losses from your rentals. Between $100,000 and $150,000, the benefits phases out 50 cents on the dollar, and at 150K AGI and above, it's gone. So Megan's AGI of 165, no deduction for her losses, not yet at least, but this doesn't mean the investment was a mistake. So what actually happens to those losses? Well, they're not lost, they're just suspended. They carry forward indefinitely and can offset future passive income from other rentals or gains, and they're fully unlocked when you dispose of the property. Think of it as storing ammunition for your future tax battle. You're stacking losses in your pocket, and at the right time, you can cash them in. And if you're making over 150K, there's still massive upside. And this is the part that most high earners miss. Even if your losses are suspended now, you still get powerful benefits. One, the depreciation reduces your basis. Your property is quietly depreciating behind the scenes, and this reduces your capital gains when you eventually sell. That means less tax down the road. Cash flow is still tax advantage. So rentals produce cash flow, but because of the depreciation, you may not pay tax on it at all, even with the suspended loss. Suspended loss equals future deductions. Eventually, when you sell, you can offset the capital gains, passive income, or trigger a massive refund if you use them strategically in a down income year. Let's talk about 1031 exchanges too. If you use a 1031 to swap the property, those suspended losses stick with you and you can continue deferring taxes indefinitely. Let's talk about the inheritance reset too. If you hold property until death, your heirs receive a step up in basis, and all of those suspended losses are wiped. No tax, no recapture. You just gave your family a tax-free reset on a lifetime of passive paper losses, and that's why high earners stay in the game. If you want those write-offs now, here's how to unlock them. One is the material participation. If you hit 500 hours or pass 100 hours plus more than any one test, you can unlock those losses on the rental. Two is the short-term rental loophole. And let me preface that again. The material participation, you still need to either hit the short-term rental loophole, self-rental, or real estate professional status. So let's talk about the short-term rental loophole next. If your average stay is under 7 days and you materially participate, you don't need the rep status. Sorry, the wind's kind of blowing out here. So this is a sweet spot for high income earners looking to unlock big year one cost seg losses. And this is what most people hear about. Another thing which I've already mentioned is the real estate professional status. To qualify for this, you need to spend at least 750 hours a year in real estate, more time in real estate than any other job, and you must materially participate in your rentals. You can group activities though by combining multiple rentals into one activity to meet those participation thresholds. You can also harvest suspended losses. So you can sell low performing properties and use those losses to offset capital gains, or pair a sell with a high income year for a strategic refunds. One of my clients, let's call him Kevin, makes $400K plus a year as a surgeon, and he owns 5 rentals. He definitely is not going to qualify as reps, and all of his losses are suspended, but each year those losses grow and he still enjoys the cash flow with almost no current tax on that income. Let's say in year 5 he sells one of these properties at $180,000 gain. That's $95,000 in suspended losses across his portfolio to offset the gain. 0 taxes owed on the sale. The moral of the story, whether you're under or over 150K in income, is that long-term rentals work if you know the rules. So don't get discouraged by suspended losses. Know that they'll pay off. And if you want those deductions now, you can help unlock them. And if you want to talk more about how to use these strategically, book a free 15-minute discovery call at bristertaxlaw.com, and we'll help you map out your strategy, whether you're planning your first property or optimizing a 10 million portfolio. And if you like this episode, share it with a high income friend, subscribe, leave a review, so we can keep creating content that helps you protect your assets and maximize your wealth.